Thank you very much. This is Ben Hobbs, Chair of the Market Surveillance Committee. Welcome back. So this afternoon, we're going to start off with system market power analysis discussion, and we're going to have two presentations actually go a little bit back and forth between them since they cover similar ground. Amelia and Perry on the analyses done by ISO staff and DMM. So I think, Perry, you're kicking it off, and then we'll tag team with Amelia.
All right. Thank you, Chairman Hobbs. Just as some background on this topic, I think last year today, June 7th of last year, the DMM presented their results of their RSI that looked back on 2017 from 2018. And they had various recommendations that the ISO start to look into this. And they track system-level residual supply index metric that shows that showed growing uncompetitive conditions. So since then, we've completed our analysis, Guillermo's group, and what we're after here is a well-rounded observation of system-level market power conditions in our energy markets to inform our policy decisions. So what I have in the agenda today is to talk about that structural competitiveness analysis, and this should be a shorter discussion because we want to move on to then Amelia with some new results from their analysis, and then have some other considerations before we get into the policy options. Okay, so this should look familiar because we presented this, or Guillermo presented this to you guys at the last meeting. We conducted a system-level structural competitiveness analysis using an RSI that had the following demand and supply assumptions, and I'm just on this slide just to highlight so nobody gets confused what the differences were between the scenario that we came up with that showed 55 hours of uncompetitive conditions and the DMM scenario. So on the demand side, we used the day-ahead demand forecast. We used the ancillary services requirements. We included self-scheduled exports, and we included losses. And both of these second two, the last two, self-scheduled exports and losses, the DMM did not originally include, and I understand that now they are including those in their analyses going forward. On the supply side of the equation, we used available physical supply that's bid into the day-ahead market rather than the market-committed generation. And that was this graph that we also showed at the last meeting where you have the available supply bid in, which is the blue line at the top. And that available supply is adjusted for outages and derates on the generation. That's different from using the committed supply. The committed supply is an output of the optimization, not the input into the optimization. The optimization actually does have all of the blue line available to it to try to come up with its minimum cost dispatch. The other supply assumption we had was we used the gross virtual supply bid into the day-ahead market, and DMM did not include virtual supply in their analysis. So related to the virtual supply, this is the RSI equation, and this term, the PS, is the physical and virtual supply. We use the bid-in virtual supply, and in its gross quantity not adjusted for virtual demand. And our thinking there was, it was actually kind of hard to see the forest through the trees on that one. We were looking at the virtual demand and we said, well, you can't really just subtract virtual demand from the demand side of this because the demand side of this in this scenario is the day-ahead forecast. And what does it actually mean to subtract virtual demand from a day-ahead, CAISO day-ahead forecasted demand? So we use the virtual, the gross virtual supply. I believe you guys mentioned at the meeting, the last meeting, and also we got through stakeholder comments that the real question was, what are you intending to represent by including virtual supply in the first place, and what I'm conveying here on this slide is that we are intending to try to capture unscheduled supply that will be available in the market that was not scheduled in the day-ahead market. So to that end, we think it would be reasonable to include the net virtual supply offered into the market, and that would be, we would adjust this PS term in the equation to have the virtual supply minus the virtual demand in this equation. And I think if we're not already running that scenario, I actually don't see Guillermo. Oh, JK's back. If we're not already running that scenario, we plan to run that one very soon. Okay, and then do we have a? Yeah, sure.
This is Ryan Kurlinski from DMM. So why not, if the intention of doing net virtual supply is to capture, is this thing working? If the intention of the net virtual supply is to capture supply that is in the real time, not in day ahead, why not just try to directly estimate that, right? Because I mean, just virtual supply on its own, and it's meant to converge day ahead to real time. So if you have underlying market power in real time, say, in a certain scenario, you have like one company that's selling generation in real time, and then, its prices spike to $900 in real time. You're going to get virtual supply. You could have an infinite amount of virtual supply bidding in at, offer to sell at $910. That doesn't make that virtual supply increasing the competitiveness of the underlying market conditions.
So I kind of hear two questions there. First, should we be including high price bids, which I think you guys have a slide on, and then the second is, why not just use the actual observed supply that shows up in the real-time market?
Yeah,
it's not scheduled in the day-ahead market.
Yeah, I'm not asking the first question. I mean, I'm not talking about including or excluding high price bids. I'm just talking strictly about virtuals at all. If the intention of including any kind of measure of virtuals is to get some kind of accounting for the supply that shows up in real time, not day ahead. Why not try to directly estimate that rather than relying on net virtual supply?
Yeah, the first kind of thought that pops into my head on that one is that we want to keep this as close to apples as we can, so that if you imagine what the virtual suppliers are doing in the day ahead market, they're acting on information that they have as of the day ahead market to make a decision about how much virtual supply and demand to put in. So they have a view of what's actually going to happen, just like every other market participant has a view of what's actually going to happen. So if I have bids that are going to reflect the market's aggregate decision of what's going to materialize in real time, then that seems to be more on an apples to apples with comparing with other supply offered into the day ahead market. We're trying to keep it supply offered into the day ahead market.
I guess I don't want to waste too much time on this, but how straightforward, it seems like it's not straightforward, but maybe would it be to actually measure the amount of supply that appears in real time that is not being bid into the day-ahead market? That's kind of conceptually, I think, what you're trying to capture, and I don't know whether that's observable or so. I'm not sure if there's a straightforward way to do what you were sort of asking, and that would be one reason not to do it, because we don't know how.
You could take the difference between the scheduled renewables and the forecast of the renewables.
But that's just one. I mean, there's other things that differ, too. But we could analyze real-time supply instead of day-ahead market. I mean, it started with analyzing day-ahead market supply-demand balance. But we could instead analyze real-time supply-demand balance. I mean, it just...
Yeah. Okay. You could then take the net cleared virtual, but to put in the net bid-in virtual, we won't argue either. We'll address that, and we address it in our paper too. But so that's another suggestion. If you do really want to get virtuals in the day ahead, you could do the net cleared. So.
Well, but I mean, then we could do physical cleared.
You
could tautologically find it fails. If we just put the cleared demand and cleared supply, obviously it failed the Bivell supplier test. The point is, I think the issue is to what extent do they constrain it from going up? Didn't clear, but would have cleared if the price rose, right?
Yeah, that was our thinking.
Yeah,
that if we tried to start to evaluate a cleared quantity on the virtual side, but evaluate that against a bid-in quantity on the physical side, that again gets you further away from that apples to apples. And all of this may be a moot point anyway, because taking the virtual demand out of the virtual supply may get you close to all of these other numbers anyway. I mean, that's what the virtuals are trying to converge those markets anyway.
So it's Michelle Keogh from the CPUC. I thought that what we're trying to look at is the structure of the market and whether it's competitive. So they also said we're not even looking at bids. We're just looking at the resources that are available to make a competitive market. So you're saying virtual supply is able to do this, but we're not even looking at the this. We're just trying to say, is the market structurally competitive? Do you have enough players at every single time, right?
Then we should look at real-time supply and real-time demand, because that would show the real-time intermittence that showed up, the real-time imports that showed up, and the real-time demand.
But I don't think
if we go into ahead where we got intermittents that aren't bidding in because of the structure of their contracts, we're not really seeing the physical supply.
Well, I'd say that that's probably more representative of the market. So if 90% of it clears in the day ahead, so we should look at the day ahead. Well, and so one portion of it shows up in the real time. So no. Think that.
Well, but the supply that shows up in the real time is proxied for by the virtual supply.
Perhaps, but that's the question, right? That's what we're trying to get at. Does the virtual represent that actual supply?
Right. So we could look at real time and see, because that's the real time supply. We could say, is real efficient to meet real time demand?
Okay. Well,
and you know, in a sense, we're not really. I mean, this is not a structural analysis in how I'm sort of used to thinking about this, which would be looking at installed capacity or some kind of capability generically against certain types of peak demand. You know, we are looking at actual offers into markets on a daily basis and adjusting for ramps and those sorts of things. So this is a strange kind of hybrid analysis of what we would normally think of as structural that at least at a system level would happen in like a merger or in rate-based authority or something like that versus an ex-post analysis, which this is kind of doing. This is an ex-post analysis, but of the structure, which makes it a little strange, though, because it wraps in the outcomes of the market, which is not exactly what a structural test is normally used for.
If I just to summarize what we'll leave it at this, but say there's a competitive price, it's $400. If you have a bunch of virtual supply at $700, that might prevent the price from going up to $900. But it doesn't. Our position is it mitigates, it somewhat reduces market power, but it doesn't eliminate market power. So we'll leave it at that. We think high-priced, if it's competitively priced virtual supply, fine. But if it's uncompetitively high-priced, we don't see how it mitigates the physical market power.
Now you're saying we shouldn't use the pivotal supplier test. The pivotal supplier test doesn't look at how cost-effective it is. The conduct and impact test looks at what are the actual offers, what are the actual constraints, what is the actual impact on price. The three pivotal supplier says, can we take out the three largest suppliers? We make a whole lot of, if we were looking at what's within $10 of the price, then we should use like a 1.5 pivotal supplier test, not a 3 pivotal supplier test. The 3 pivotal supplier test is used because we've got all those fuzzy assumptions. Yeah, we know we got high-cost supply in there. We know we got supply that's constrained down. If we wanted to account for those, we could use a conduct and impact test.
This is Michelle. But if there's 6,000 megawatts of virtuals and we don't think that they're real, then we're not really counting supply, right? We're counting the speculators. So that's what I'm struggling with here, and I just don't think we did a very good job of thinking about whether we're dealing with speculators who don't have physical assets and those that do.
It's reasonable to take a second approach and look at real-time supply and demand balance. I'm not saying that's unreasonable. I'm saying that's a reasonable bookend. Look at the virtual supply, the net virtual supply, as one measure of what was actually there in the day-ahead market to constrain prices, but then also look at what actually showed up in real time. Did we actually see a bunch of extra imports show up that are consistent with the virtual supply? Did we actually see intermittence that showed up?
Okay.
Did we actually see QFs that weren't bidding in day ahead? And if we don't, then fine, then we'd see, okay, We don't see it, but let's see whether it is. You know, just look at the physical, look at the virtuals.
Okay, that's fine. If you do both, look at the physicals and the virtuals. And then also, I also think that the whole purpose of market power is to try to identify it before it actually becomes an issue. And I think this ex post thing misses the mark. So we can spend a lot of time looking at this and saying, oh yeah, it is not exactly uncompetitive, but 3% of the hours are 3% of the hours. The question is, what direction are we going?
It's 3% of the hours when it fails the three pivotal supplier test. That does not mean it's not competitive.
Absolutely, you're right.
The three pivotal supplier is extremely restrictive because of these limitations.
Right.
So it says in 3% of the hours it's conceivably non-competitive.
Right. But then why wouldn't you continue to study it? I'm not saying that there is anything that we do, but I'm saying that do we potentially have an issue? And I think the answer is clearly yes, the direction we're moving. You can see what's happening. You can see. Anyway.
I think, okay, I mean, I think we should defer that topic or, you know, that line of discussion until after we get through this analysis, but.
All right, so I'm also hearing that there are additional ideas in the room about how to refine the analysis than the points made on this slide. So the refinements that we came up with were to do the net virtual supply offered if we're still evaluating the competitiveness of the day-ahead market, and to include ancillary service offers that are not overlapping with energy offers. And I think the DMMs had some success untangling those two things, which they'll present in their slides after this. At the end of the day, the result's going to be somewhere between 55 and 272 hours because you're going somewhere between no virtual supply and all virtual supply. So, you know, we're just narrowing in exactly what number of hours we saw in 2018. We did get some comments about, you know, trying to attempt it to project it going forward. We did not attempt to project the residual supply index going forward. We hear a lot of people mention that, oh, you know, you have a lot of generation that's retiring. That's great observation on the retirement side, but you also have a lot of generation that's interconnecting. So you have to look at both sides of that coin, we think. And also there's the sticky question of the ownership and participation aspects, which is that you can have resources transition between owners, and that will definitely impact what happens in the RSI calculation because it is a three pivotal supplier test. We would need to make assumptions about total import supply available in the future. Not sure if this exactly tracks to how it was in the past. And then also we'd have to make assumptions about the quantity of supply that each particular affiliate would offer in each hour. So, you know, we would have to. The point is, this gets kind of fuzzy, and we would need to try to project all of these things into an hourly granularity because we're trying to figure out how many hours in the year do we expect to fail this test. So this is to say it's not necessarily a simple tweak to the existing study that we did. There's a lot more assumptions that we would need to make here, and I just wanted to maybe pause here to see if anyone had any observations or questions about this. Okay, seeing none, I think this may be a good time for the DMM to talk about their RSI analysis. So the topic stays the same, talking about the RSI analysis, and we'll jump to DMM.
While we're transitioning the slides, I'd like to say that DMM's analysis was actually misstated in the ISO's report. So just as Perry said, if you are going to try to project into the future, you have to make a lot of assumptions. That's absolutely not what we were doing. We were rerunning the 2017 results with the change in ownership and showing the impact of that kind of a change. So thanks for that. As Perry stated, we have replicated the ISO's analysis for the most part. What we've done here is take out ancillary service bids that don't have overlapping energy bids. So the top rows of this table, sorry, I will stand up taller and speak up a little bit. The top rows of this table show the input assumptions in our RSI analysis. This is published in our comments on the ISO System Market Power paper, which are publicly posted. I'd recommend to anybody who's interested in this to read our comments, but also please do read PG&E's, FCE's, San Diego's, CPUC's, PowerX's, and quite a few more. Our analysis was based on input bids, including transmission losses, self-scheduled exports, but the one published in the paper did not include ancillary service bids, which in our day-ahead market are not necessarily overlapping with energy bids. The table on slide 3 is showing a comparison with a version of this model that we ran, including ancillary service bids without overlapping energy bids. So a huge thank you to Kyle, who worked on this analysis for many, many hours. We were able to get that in. It makes some difference, not quite as much as you would expect. The first 2 columns show the version without those ancillary service bids. The second 2 show with the ancillary service bids. The third column shows 43 hours with a RSI 3 less than 1. That's including all of the virtual supply.
Is that gross virtual supply or net?
Yes.
Gross.
So that's our effort to replicate the same analysis that the ISO was doing. The final column lists our RSI results without any virtual supply at all. So, and that's, I think, Perry, where you're pulling the 272 number. Yeah. The reason we ran and chose to publish these results is really that in running a lot of different sensitivities, what we found is that including virtual supply, and especially including virtual supply in the way that the ISO's analysis was doing, is what was really determining the difference between our model and our results. The chart on slide 4 is a version of what we published in our annual report. The green shows average hourly offers for virtual supply. Dark green is the cleared quantity. Light green is the offered but not cleared quantity, on average for all of 2018. Blue is virtual demand. Again, light blue is offered but not cleared, and dark blue is cleared. Yellow shows the net cleared virtuals over the entire year. So there are hours, and they're particularly in hours 19 and 20, where you see that our net cleared virtual supply and demand is negative, and in the virtual demand. And we looked at some of these results in our most concentrated hours. So if you look in our most concentrated hours, about 2/3, so it's a little over 65%, have net cleared virtual supply, and about 1/3 have net cleared virtual demand. On average, for the most concentrated hours of the year, so with RSI 3 less than 1, we found there were about 440 megawatts of net cleared virtual supply. So that compares to a value of something close to, I think, 5,990 of virtual supply bids that were included in the ISO's original analysis, so substantially less. One of the other suggestions that was offered by a number of different commenters was that we look at potentially uncompetitive bids and whether or not those uncompetitive offers should be included in supply. So the ISO is also looking at this. That's in part when you're including self-scheduled exports in demand that's similar flavor. What this table offers are a set of changes in offered supply by price category. So if we exclude bids between 1,000 and 990, we see a reduction of about a little over 400 megawatts of imports, a reduction of 67 megawatts of gas, and 58 of DR, 17 of import ancillary services, and a total reduction of 545.
Amelia, is this, when you're talking about, this is Michelle Keto from the CPUC, so you guys have done some analysis on what you were concerned about, some imports bidding at $1,000, and you were somewhat concerned that those are speculative supply, so the bids aren't backed by physical assets. So here, you're saying that the imports that you might consider taking out are the 404 that were bidding at $1,000 and potentially don't actually have energy behind them, or physical assets?
Potentially.
Potentially. Okay, thanks.
So the other price ranges, and again, this is a matter of choice. You know, where do you want to draw a line for potentially uncompetitive?
Amelia, can you elaborate a little more on the logic for pulling out high price supply? Because, you know, the RSI is supposed to look at the mix of suppliers and determine whether they have an incentive to, you know, bid costs or exert market power. So it seems like we're kind of mixing apples and oranges. I'm just not following what the significance is of the prices. I mean, that's not even part of the RSI metric.
Sorry, this is Michelle Keto at the CPUC. Amelia can answer on her own, but I think that was the whole purpose of the RA initiative, right? CAISO has said that they're concerned that the import bids are speculative supply. So I think the point is that potentially these aren't backed by physical assets, and so there are certain resources that are potentially bidding, but there is nothing behind them, potentially. So I think that's the issue, right? You guys have raised this concern.
But that doesn't mean there aren't other assets out there that could bid into the market. And this is why I have trouble getting my head around exactly what this kind of thing measures. Because if there's a bunch of capacity out there that's not owned by the three largest firms, a structural test would consider that as potentially competitive. It's not bidding in, but we don't really know why. And so that's why this is informative, but it's not clear exactly what we can conclude from either one of these studies.
So what would you do?
Well, we'll get to that, but I mean, I think for a retrospective analysis, I'm more interested in the competitive benchmark analysis. And I was going to ask about how that relates to anybody's RSI results. For prospective, you know, that sort of gets to your questions and some of the other aspects. It's hard because, as people have said, when you start doing prospective, it becomes endogenous to the market. People will build stuff, people will sign contracts, and that changes who's in which category and those sorts of things. So it's more of a scenario kind of analysis than it is anything about describing what the future will be. You could sort of say, hey, if nobody builds any more generation, you know, we may have a lot of market power, or, you know, it always bugs me about capacity sort of studies. If nobody builds any more generation, we'll run out of capacity. Well, you know, we're sort of expecting the market to continue to respond to what the future is telling.
Right, but we've already made a determination, for example, that the local areas are structurally uncompetitive, right? So we've already come up with a way to address that. So there are areas that we just accept are structurally uncompetitive.
Right, but that's because for local areas, we're assuming there are restrictions on entry, restrictions on transmission, and other things that are more sort of chronic
and
not transitory in the way that they would be at the system level. And we also kind of are looking at actual congestion into those areas, where here we're not necessarily looking at maxing out the imports into California. We're looking at what imports were offered in at any given point in time. So a structural analysis maybe could assume, well, just add in the entire import capacity into California. But then you'd have to sort of think about whether we're netting out. It's hard to sort of separate this out from sort of some kind of structural test of the entire West, in a sense, if you're doing a kind of structural measure.
If I could just add, the reason we did this every year, it's a standard metric most market monitors run, where they run the HHI. PJM does have a price threshold. They do a price screen in their pivotal supplier test, so it's not unheard of. And actually the reason we did it a lot of times is to watch the trend, because you could see the market becoming less competitive before it might show up in market prices in the other metrics that you have.
Yeah, and I guess I said this, but probably nobody caught it. I think there is information in all this stuff. We just have to be careful in sort of figuring out exactly what information to take from it.
Operator, we'll go ahead and take the question on the phone, please.
Hi, good afternoon. It's Mark Coleman. I just want to follow up on the point that was just made. I think one important consideration in the West when you're thinking about imports and you're thinking about what are the import offers that are going in, physical import offers relative to the import capability, an important consideration is that the day-ahead markets in the rest of the West transact a few hours prior to bids being offered into the CAISO. So there is that circular piece that, entities are going to evaluate the opportunities, entities that have surplus, to sell in the external markets day ahead versus offer it into the CAISO. And so I don't know the answer to it because I know it's a tough challenge, but just how do you assess the imports? Because there's a bit of circular nature to that if the prices outside are higher or expected to be higher than the prices of selling into the California market, then your import offers are lower, but that doesn't reflect the supply that could be available depending on the relative price signals, both to production cost of, for example, buying gas, et cetera, but also relative to opportunity cost of selling your supply on a different day or into a different market. And the CAISO day-ahead market operates after the day-ahead market elsewhere, and so your import offers reflect kind of residual offers after supply has been sold elsewhere and have been made outside the grid.
Okay, thanks. Julia?
Unless we want to switch back to the end of Perry's presentation, what I'll do is present some of the material that was in our annual report. The link to that report is at the bottom of this, and I'd highly recommend that anybody who's interested
Available at your favorite bookseller.
Available in hard copy, that's right, for free. So in sum, though, our general result was that CAISO's energy markets were generally competitive in 2018. However, prices in the day-ahead market were significantly in excess of competitive levels in some hours when net load that must be met by gas-fired units is highest. So, and again, as Michelle Quito stated, the market for capacity needed to meet local requirements is structurally uncompetitive.
So, yes. I suppose this is as bad a time as any to ask the question about how do the hours identified in bullet 2 compared to those hours identified in slide 3 as being RSI 3-1. I mean, do they line up?
Yes. The short answer to that question is yes. But I think I have a slide for that, and I think Perry has a slide for that too. Brian.
Yeah, thanks, Amelia. Brian Thaker with NRG. The second bullet seems very carefully written, and I want to try to see what it means and what it doesn't mean. It does say that you had some high-priced bids from gas-fired units in the tight hours, but should one not read into that the prices were or were not set by gas units in those hours?
I have a slide for this as well. What we found is that in some hours, prices were significantly in excess of the highest gas DEB segment. Even on those days, we had some very high-priced gas days this summer. So I think you had in the South $40 gas on a day. But
Brian, I can probably help a little bit. Imagine a scenario where a significant portion of gas is bidding at, say, $1,000. You could have some virtual bids at $700. Our competitive price may show the price should be under $700. But so a lot of these hours, if I recall immediately, it's basically virtuals that are setting the price.
Typically.
And that was my point. They're setting it at an uncompetitive level above what we think, it would clear if you had all the, gas bidding in competitively. But they're mitigating market power. Mitigating means, lessen. It doesn't mean eliminate. So they may be lessening the impact. If they weren't there, the price could go higher. But they're kind of setting the price, at a higher level. So does that help, Brian? It's actually virtual quite often, if not most frequently.
Yes, thanks. I mean, obviously it doesn't disclose what units we're setting price, but you described a scenario where I can now successfully translate this bullet.
Thank you. So one of the things that we look at is behavior. So this is a chart that compares the bids of gas-fired resources in a particular hour of the day-ahead market to their DEBs. The bids are shown in green. No, the DEBs are shown in green and the bids are shown in blue. Sorry, it's the same color on the screen here, so it's hard to see. Yeah, exactly. These are the bids from net sellers, so people who are selling more capacity than they buy, and I put this before the net buyers. What we see is for net sellers in our market, there's a significant part of that supply curve where offers are substantially above the default energy bid segments, which in our market is one estimate of the marginal cost of that energy.
And Amelia, can you clarify, default energy bids include what kinds of adders on the variable cost and on the gas price index cost? Gas price indices are calculated based on a hub price that's captured the night before, plus transport costs. DEBs also include operations and maintenance. They also include GMC. They can also include greenhouse gas, and they also typically include a 10% adder. Great. Thanks. There are different flavors of DEB, so that doesn't apply to everybody. Okay, thanks. Yeah.
I'm sorry, Amelia, if I can just, Brian Thaker, the DEB would or would not include the major maintenance adder?
Major maintenance adders are part of commitment costs. DEBs have an operations and maintenance adder that is set by default in the tariff but can also be negotiated. So.
Aren't the DEBs updated in the morning when we update the gas prices for the day-ahead market?
For the day-ahead market, we do update our gas price indices at a little before 8:30.
And that's used for the DEBs too, right?
That's correct.
Yeah, so and you said it's the night before because, we've had some issues with the gas prices, and so it's a little bit more accurate than the night before would imply.
Yeah, Michelle Keough from the CPUC. I think you're going to switch to net sellers. So to the extent, we don't think that there's anything structurally different in terms of the major maintenance for net sellers versus net buyers, right?
In terms of major maintenance?
Well, okay, so I think the implication is, those default energy bids don't include major maintenance, so that would explain why a bid is greater than the default energy bid, but that wouldn't explain why net buyers and net sellers have different bidding behavior.
Yeah, I'd like to point out two things about this chart that's relevant to that. If you look at the chart for the net sellers, you'll notice that default energy bids are almost identical to the DEBs up to $400. Now, if you look at the net buyers, you'll see that the costs are just about the same up to $400, but once you get over $400, their bids are higher too. So, the question is, should we be looking at the actual gas prices on these days? Should we be looking whether both the net sellers and the net buyers that have the high gas prices are down in Edison territory, that they were facing SoCal gas penalties, and that both of them, for some of their generation, were bidding high? And that, yes, the people that are outside that area, the people up in the PG&E territory that were facing lower gas prices, the DEB was better aligned. So maybe this is a difference in behavior, but maybe it's actually just where the generators were located and how much was in the area affected by Aliso Canyon gas uncertainty. And, you know, I went back after seeing these slides and read back to the trade press about what was going on in Aliso Canyon and SoCal Gas on those days, so I'm not sure what this means.
I've been Michelle Quito. Yeah, that's interesting. But even if the gas was 40, to get to 1,000, you would have to have a 25,000 heat rate, which seems almost impossible.
The gas price wasn't 40. Suppose we're talking about the penalties that the CPUC has wanted to reduce, and they were looking at the.
It was 40. So.
That was the gas price. That wasn't including the penalties.
No, that includes the penalties. It was embedded, so it was $15 for gas at the city gate, and the OFO penalty was $25. So the city gate gas price was trading at 40. So it included the penalties. So, okay, thanks.
Yeah, we did include analysis in our report. We saw this summer that kind of the threat or potential for penalties really was showing up in the next day gas market. We included some analysis in that, in fact, and we submitted it in the CPUC case. So we saw kind of the migration of the potential situation to higher next day gas prices, which would be the ones we're using.
One other point I'd like to make on this chart is, although the conversation's focused on the number of bids that are coming in above DEBs, we also see a fair number of bids that are coming in below, especially in the self-scheduled area and especially, obviously, for net buyers. Some of the analyses that I'll talk about replace a bid with the minimum of a DEB and the bid. The replication of the day-ahead market software that we typically call the standalone actually replaces all bids from gas-fired resources with their DEBs. So sometimes it's actually raising bids, and you'll see that in the results. One of the new analyses that we did this year was a price-cost markup. What we did is construct a system-wide hourly day-ahead supply curve and a system-wide hourly demand curve, and calculate the intersection of that curve. The green line on this chart, and I'm guessing at the colors a little bit, the green line on this chart is showing the average system marginal energy cost for the year, and the blue line labeled base case is showing what the intersection of those system-wide supply and demand curves would result in as a price. Obviously, it's lower, and that result would make sense for two reasons. One is that the system-wide analysis isn't including any impact of congestion. It's also not including any of the resource level kind of ramping or intertemporal constraints that you'd expect to see. To run our competitive scenario for this, we are taking the bids of committed gas resources and replacing those bids with the minimum of the bid and the default energy bid for those resources. Then we're recalculating that intersection of the supply and demand curve. That's shown here in the red dashed line. We then calculate the price cost markup as the difference between the blue and the red dashed line in each hour. We did that for all of 2017 and all of 2018.
The blue and red or the green and?
The blue and the red.
The red.
The blue and the red.
The base case versus the competitive
scenario. Yeah. So
I'm trying to abstract away from all the other.
Exactly.
Just sort of stacking.
So we're doing this as an experiment and changing only one thing and then looking at the difference. So yeah, exactly.
This is constructed different. This is constructed different, and the bid stack is constructed differently, and what would be the actual?
For a very conservatively small set of resources. So this is a very conservative scenario because it's only looking at committed gas resources. So this isn't taking any kind of economic withholding into account, for example. We hope to publish some more sensitivities that look at other versions of this if there's interest in that. We ran that for all of 2017 and all of 2018. And what you see comparing one to the other is that the markup on average by hour increased in 2018 compared to 2017. 2018 is in yellow and 2017 is in blue. We also show this as a duration curve, so just rank ordering the price-cost markup by hour. And what we see there is in blue, the price duration curve for 2017, shifting up in yellow for 2018. We did a second analysis that looked at the difference between the clearing price, system marginal energy cost in the day-ahead market, and the highest cleared DEB segment for a gas resource.
So, in other words, you're just looking at all the gas units that we're on, pick the most expensive one,
yep,
and look at the difference between its DEB and its bid, and the market price? Market price. Okay, so if the market price is being set by a virtual or something, then it's okay.
Yeah, but it's not. We didn't rewrite. It's the bid that was dispatched, not just. It was the point on its bid curve where it was dispatched. And the reason this is conservative is units can get dispatched. You know, they can be ramping up, ramping down, constrained on for different reasons. So if a unit was operating up there because of local congestion, for instance, we might pick that up. Other constraints. Yeah, you know, this is another way of coming at it since rerunning the ISO software didn't work. You know, we came up with a variety of metrics, RSI, different ways of calculating the markup, because just to, again, kind of substantiate the point that, you know, 2 points. We were seeing some high prices in ramping hours, and there was an increase compared to 2017.
Right. Well, one thing that jumped out at me is that the 17 to 18 picture here
is different.
Is the opposite of the previous one.
And that's, well, that really goes to, I think, Scott's point, which is gas prices in 2018 were substantially higher than they were in 2017. So if you measure the difference this way, what you see is that gap was actually getting smaller, and really we had higher prices, but we also had much higher gas prices, and that's what the explanation is.
And back to Ben's question about like correlating hours, it's kind of hard to tell with the vertical axis here, but on both of your duration curves, you know, it kind of looks like you get to about 50 hours, and that's where it starts really kicking up. And so, you know, 50 was kind of like the RSI 1 on one of your studies, and it's the RSI 3 on the ISO study, so I'm not sure what the magic 50, you know, really should be, but it seems like maybe trying to, there's a little more to just the rough correlations maybe that we could look at in terms of what's going on with the measures of the structure in those hours. I don't know if you've already looked at that or not.
One thing I'd like to note is that the hours that we see as being most concentrated have been consistent. So it continues to be these hours 19, 20, and 21. Yeah.
I'm here, Brian Thaker with NRG again. All of these graphs from 10 through 12 don't differentiate between gas owned by net buyers or net sellers. It's just gas in general, correct?
That's correct.
Yeah.
Amelia, for moving on to slide 10, so I think we talked last time about the merits of using the minimum of the bid and DEB versus just the DEB. What would this look like if you'd done the analysis, the competitive analysis based just on DEBs? Would these all disappear? Or would they still be?
There it is.
There it is.
This is, okay, so they do all disappear.
Well, I had trouble reading this graph too, but
okay.
Bars and lines.
Bars and lines.
This is using day-ahead market software rather than...
Yes.
So it's there's other stuff going on too. And the reason I ask that is that if the DEBs are an unbiased estimate of true marginal cost, sometimes they over, sometimes they under, then when if one chooses the minimum of the DEB and the bid, then that will tend to underestimate marginal cost. If people are really bidding their marginal cost, then taking the minimum of the DEB and the bid will underestimate marginal cost. Again, if DEBs are unbiased, then people are really being honest. So this slide 10 might be just that reason, might be overstating price-cost margins.
That said, though, DEBs are designed to include enough headroom to guarantee that marginal costs are. So.
Yeah, by design, I think it may be a stretch to push them as unbiased. If you think the original gas forecast is meant to be the unbiased, then mechanically you're adding 10% to that. Now, there's a lot of error there, and so when they're off is going to be kind of, that's where it gets more complicated. Like you're much more likely to bid below your DEB when the forecast is off, and so, or above. And I would also say that, I don't know you could interpret your net buyer slide as either, more accurate of true gas costs because their bids are below their DEBs, or it's perfectly within their economic interest to bid below their cost as well because they are net buyers. So it's not clear from, that. It would be interesting to sort of see how these lines look if you have a measure of just how net buyer they are, because normally the economic theory thinks of those lines as crossing right at their net buyer position, and I don't know if that's true or not. But
so I just want to add a little layer to that, Michelle Keto. The utilities are required to bid least cost, so every year we check their bids to the penny, so they are required to bid marginal costs. So they are not allowed to put in any adders. I mean, some opportunity. Well,
are they allowed to bid below their cost?
No, they're allowed to bid their variable costs. So.
And how? Okay. Well,
and it goes through an entire ERA proceeding. ORA looks at it. So they are required to do least cost dispatch, and the only way to guarantee that is if they do variable cost bidding into the market. So to the extent that you get net buyers, that's usually the utilities who are subject to some.
Okay, but I mean, I guess if the principle is least cost sort of net procurement, then it would actually be of lower cost for a net buyer to try to lower the wholesale market price because their purchases would then be at a lower price. And so, the idea would be you're losing some money on the generation side, but you're saving it overall.
Yeah, no. Thanks.
Just a quick reminder to everybody use their microphones, announce who you are, your name and your affiliation. We're getting feedback from the phones that they're not able to hear. So please make sure you announce who you are and use your microphone.
Yeah.
This is Scott Harvey. For these last few diagrams, which ones are using, is the page 13 using the bids that have been mitigated by local market power mitigation when you say it's using the day-ahead market software?
So let me explain the analysis that we're showing in slide 13, because we haven't done that yet. What we do is take an offline version of the day-ahead market software, and we run a very simple scenario. It takes the bids of all gas resources and replaces all of those gas resource energy bids with DEBs, whether those DEBs are higher or lower. What we're showing on the chart in green is and I'm apologizing again, green, is the average load-weighted base case price. So that's what we get when we don't make any changes at all. And we just...
Does that use the mitigated?
In that. The mitigated is to
the base case is rerunning the market software. So it includes any local market power mitigation if that would have occurred. It's not enforcing mitigation. Does that make sense?
But default.
If the mitigation would have been triggered, it would be reflected.
That's correct.
Okay. Is this kind of enforcing system market power mitigation? Because don't you mitigate to default energy bids? So you're rerunning the day as if everyone was mitigated to DEBs?
So not everybody is mitigated to DEBs, first thing, and Second, we're not replacing all resource bids with DEBs, only gas resources.
I think the distinction is that the local market power mitigation is only triggered when within the local regions. It isn't replacing everybody's DEBs, but it is those people that are already being mitigated today are being mitigated.
Yeah.
Whereas in the other, on pages 10 and 11, are you using the mitigated offers out for those people, or are you using the offers before they were mitigated for local market power mitigation?
So for 10 and 11, what we're doing is comparing to a competitive scenario that replaces the bid with the minimum of the bid in the DEB for gas resources.
Right, but in the markup, are you comparing the DEB to the mitigated offer, if it was mitigated for local market power, or to the offer before it was mitigated?
We're making that change as an input before the market software runs its local market power mitigation.
Okay.
So in local market power mitigation, if you're subject to mitigation, your bid is compared to the competitive LMP, so essentially the price on the other side of that constraint, and your DEB. And it will be lowered to the maximum of those two things. If you happen to bid in below that, it won't be lowered at all.
Right. So I just wanted to know on pages 10 and 11 if they were the same as on 13. So 13, you're comparing mitigated bids. The base case uses mitigated bids. And the comparisons on 10, 11, and 12 also use mitigated bids for the base case or not?
We are not applying any local market power mitigation and the other analyses. We're just doing that very system-wide supply and demand.
Okay, so maybe some of the difference between 10, 11, and 13 is because 13 reflects the impact of local market power mitigation?
I have the slides for this in my annual report presentation. I don't have them here, but what we see is actually local market power mitigation is not applied very frequently in our day-ahead market at all. So I don't think that's a major source of the difference here. But.
Yeah, and recall there's a floor too. There's the system price is the floor. So when system prices got really high, that was higher than the DEB or the bid, so mitigation has no impact in that case. Local market power mitigation has no impact. And Amelia, make sure, so the other thing, in the summer months, if you weren't going to, you run about 2/3 of the days, and the high price days, the day-ahead software wouldn't rerun successfully or reasonably. So these results are biased toward the lower price days. And, so the days, the exact days we'd want to look at most, we don't have reruns for those days.
So we will publish results for a month if we have 80% of the days. And we had a very hard time with July and August this year, but it's thanks to a lot of hard work from parts of the ISO that aren't in this room right now that we were able to publish those results at all. And I'm thankful for that.
Okay, but it looks like, there's maybe 50 to 100 hours of real interest here, and it sounds like most of those are missing from this picture.
It's not only that they're missing, it's that these are monthly averages. So when you're taking, for instance, all the self-schedules and replacing them with higher cost bids, you're showing a negative markup. So the competitive scenario is actually solving at a higher price than the actual price that was prevailing in the market. So these are very averaged results, and that's the big impact here. 2 questions on the phone, says Shannon.
Operator, can you put the questions through, please, on the phone?
Hi, good afternoon. It's Mark Moore with Powers. Just a couple questions. I was noticing on the slides that this seems to be happening. You have the one slide where it's showing kind of our 18, 19, 20, 21. So I guess it's slide 10. You're showing a difference there kind of in the evening peak. And I think on the other slides you're showing a limited number of hours. So it appears, if I understand it correctly, that these hours are showing up on the hours of greatest scarcity on the grid or the tightest supply conditions. I know when that's happening that you often have exceptional dispatch, you have load biasing happening in the evening peak. DMM's put out some great data on showing what that looks like for a pattern throughout the day. Have you backed some of that out, or can you speak a little bit to how when you're looking at the comparison both on the competitive bench line and on the analysis of the competitive scenario on slide 9, how are you dealing with the other actions that are kind of in the other direction, like exceptional dispatches that suppress clearing prices and load bias and load bias limiter? How is that being treated, or is it in both, or is it in one but not in the other? Could you speak a little bit to that?
These are very simple day-ahead metrics, so we're not including any kind of real-time load bias or exceptional dispatch. If we did make adjustments for that and we've considered it, what we would do is include potentially changes in offered supply to account for the fact that you are exceptionally dispatching some more resources in real time. I want to give Perry some time to talk about some of the analysis that he didn't get to yet, which really does go to the correlation between tight system supply conditions and those instances in which we're likely to be able to measure some structural market power. So,
that's helpful. I guess along those lines would just be exactly on that. How many of these hours that you're identifying, knowing what it looks like in terms of remaining supply, are these scarcity conditions, and is your competitive benchmark assuming it should be the marginal cost of the marginal unit even under scarcity conditions, or is this incorporate any sort of scarcity pricing that we see in other organized markets during conditions of relative scarcity that rises market clearing prices above the marginal cost of the marginal unit?
So these are comparing our day-ahead prices to various measures. And we really
we didn't see scarcity last summer. So yeah, the bottom line there is we didn't see scarcity.
And I guess more generally, the competitive baseline with the actual market software would incorporate all of the various scarcities that the market, in principle, that the market does as well.
And it does.
Yeah.
All right, we're going back to Perry, Servideo, ISO, me. We're going to continue this train of the other considerations other than the structural RSI. So knowing that our RSI 3 failed, in these 55 hours, we had a hunch that perhaps this is happening, in times when we're in our net load peak hours, and so we pulled the data here, and I think we actually had stakeholders ask for this information as well. And we're generally seeing our RSI fail in these, in our net load peak hours of the day, and primarily there in hour 20. So this kind of fed out of that hunch, and then so knowing that it's happening when things are generally happening when things are extremely tight, we were curious how the energy prices compare to our supply reserve margins in each hour. So first off, the slide should read that high, not relatively high prices, we would say high prices and relatively low prices occur regardless of the RSI less than 1. And our highest prices are occurring when our supply reserves are extremely low. So if we focus first on the left chart, you'll see that, knowing that you failed your RSI doesn't quite tell you much about, what the prices were going to be in that hour. We actually see kind of a majority of the failure hours be at relatively low prices. And yes, you do have at the lowest RSIs, absolutely you have extremely high prices. So on the right chart, what we wanted to do was compare the supply reserve margin that we have on the x-axis to our day-ahead prices. And here's where we see that we are seeing the extremely high prices in conditions where we are in a relative scarce supply reserve margin scenario. So we heard the concern that high prices, we're hearing, hey, high prices and And these low RSI values absolutely indicate that there's a problem, and we need to, we need to look into how to do a dynamic system, market power mitigation process. But to us, what we're trying to show here is the RSI-3 value itself doesn't necessarily tell you anything meaningful about the prices that people are pointing to. It more looks like we have high prices when we are in scarce conditions, which is what the chart on the right shows.
Perry, this is Michelle Keat at the CPUC. These look almost identical to me. I mean, you can draw the line wherever you are, but to me they look like they have roughly the same shape.
Yeah, so they're identical except for the x-axis is different information.
I understand that.
So the y-axis is the price.
Yep.
So what we're saying here is that we would expect high prices in conditions of relative scarcity. And that's exactly what this is showing, is that all of these data points up here where people say, oh my God, prices are $1,000. Well, yeah, we were below our supply reserve margin. We were in a condition of scarcity. Yeah, you almost saw a $1,000 price.
Yeah,
that's
not
not necessarily.
The question. Sorry, but isn't the question, are they bidding at above something other than their marginal cost? Are they exerting market power? That's the question, right?
It's not the question if you're in conditions of relative scarcity.
Wait,
relative
scarcity doesn't give you the right to bid whatever you want to, does it?
No, scarce supply means that you have bidders on the buyer side that are competing to buy the power. You don't have enough power out there, and the buyer side is now competing with each other to buy that power.
And remember, I don't understand how we have scarcity in. We didn't have demand that was greater than supply in any days of the day-ahead market, did we? So I don't understand why you're showing a.
Yeah, what's the 100% here?
I don't get this.
The 100% here compares the supply bid in in our scenario, right? These are for the 55-hour scenario. Compares the supply that we had bid in to our day-ahead forecast demand plus losses plus self-scheduled exports plus the ancillary services requirements. Now, none of those things is the cleared demand. So what happened on these days was the market just cleared less demand.
Oh, okay.
Yeah.
So some of the offers may have reflected. This is Scott Harvey. I'm sorry, the mic off. Some of these offers could have reflected expected real-time prices.
Yeah.
Because some of the load wasn't bidding in the day-ahead market, and they knew that they'd be able to sell it at a higher price the next day if they wouldn't want to sell it cheap today if it's going to be worth more tomorrow. Okay, I get it.
Yeah, so the market is clearing on the demand here. In other words, there's downward sloping demand in the day ahead, and it's.
Yeah, I would, we could have Guillermo confirm, but if it's below 100% on the chart as we've analyzed this chart, it tells me that the market probably cleared less demand that day because that was less costly. Yeah.
This is based on the load forecast. That helps a lot, too. Load forecast
that's a good point,
losses and exports, because that wasn't.
And I think this is informative, but, I mean, back to Michelle's question, a picture like this with the actual price-cost margin sort of gets at whether there are bids or whether it's scarcity and those sorts of things as well, which is, it's tough to estimate. There are different flavors of price-cost margins, but that sort of gets more at what she was asking about.
Yeah, and you could, we could supplement this with which of these points we saw the relatively high price-cost markups and all that, because we know those hours and we know these hours, so we could, you could say, well, you got relative scarcity, that's this, you have, and then color in red dots on where did you see the highest price-cost markups, and, to the point that was made earlier, you could also say, well, a lot of these were on the high gas price days in certain areas of the system, and we have a chart on that, but I think it was just alluded to that these generally happen. You see these high prices generally on the high gas cost days, and so the next chart that we did was we compared the RSI to the RSI itself to the reserve margin. So we see more RSI failures, and this was from our scenario that showed the 55 hours. So we see more RSI failures and lower supply reserve margin hours. So this actually suggests to us that in most hours, supply is not very concentrated among a few suppliers, because it takes relative scarcity to tip you below the RSI threshold of 1. So when we saw on the previous slide, these relatively unconcentrated suppliers may not be able to push those prices up, I guess, unless you're in a relative scarce position, so day-ahead market position. So this suggests that perhaps modest improvements in the supply reserve margins on a given day, on the right days and in the right hours, could go a long way towards pushing you back up into where the bulk of the hours lie over the course of the year, which is having your RSI not fail.
Perry, this is Michelle Quito.
Sure.
In the local areas, even though we determined that those are structurally uncompetitive in every single local area, how often do we actually mitigate? I mean, we still have mitigation measures to address an issue that might not show up that often, right?
Yeah, no, so I think DMM pointed out that we rarely see the local market power mitigation flag things in the day-ahead market, right?
But we recognize that it's structurally uncompetitive, so we do have a mechanism to address it.
Well, I think it is that in a given hour it could become structurally uncompetitive on a local, at the local.
But you could equally argue that in a given hour you could have structural uncompetitive on the system level, given the stuff that you've shown, right?
Right. So the point that I'm making here, though, is a relatively modest improvement in the amount of supply offered in those hours would go a long way towards making you less structurally uncompetitive.
But
that's what this chart shows.
Okay.
And Perry, we would add, and a small change in the other direction would have kind of a knock effect too.
Yeah.
So you're kind of at the linear, where we're at the point where the supply and demand curves, where it becomes pretty nonlinear either way, up or down.
Sure, we can go to the phone. Next start's just comparing the gas to the energy.
Operator, can you go ahead and put the 2 questions through, please?
Hi, good afternoon. This is Pushkar Wagle from Flynn Resource Consultants. Can you hear me?
Yep, I hear you.
Yeah. Just a quick question on the earlier conversation that was there. And if I understand correctly, the net buyers are not considered potentially pivotal in the ISO markets, as I guess they're assumed to have no incentive to offer capacity into the market above marginal cost. I was wondering, but how are you treating the resources from LSCs that have, resources in excess of their load in the energy market? Are they subject to market power mitigation? Would they be sort of considered as net sellers?
So Amelia, do you want to? Yeah. So the point is, if they're a net seller, they're tested in the RSI as a potentially pivotal supplier.
Okay. So even if there are IOUs and they could have resources in excess of their load, they would be considered net seller and would be subject to, I guess, market power mitigation. Is that right?
Yeah, actually, if it's found uncompetitive, everybody is subject to market power mitigation, even the net buyers.
Okay.
One level
and
then the other.
Sorry, you missed that.
Go ahead. Yeah, I think. Okay.
The net buyer and seller is done over a rolling 12-month period, so it's all hours for the last 12 months. So yes, in individual hours, a net buyer may be long or short. So that's the answer.
I got you. And there was one thing that I think Michelle Quito was raising, and there was a feedback, and I couldn't hear it. But I think what's she trying to say about the IOUs participation in terms of how maybe ORAs and ORA ensures that the IOU is not offering capacity above the marginal cost. Did I hear that right? Or if she could repeat that, that would be great.
Yeah, this is Michelle Quito. The IOUs are subject to least cost dispatch, and the way they demonstrate that is to literally show the bids for every single resource, and those are reviewed in an in the ERA process at the PUC. So in general, we can expect that the IOUs, when they have resources, that they're bid in at variable cost with major maintenance to the extent that it's approved by DMM.
Okay. Thank you very much. That's all I have.
Thanks. Was there another one?
Hi, Perry. It's Mark Coleman with Power. Just one thing I wanted to highlight on slide 11 on your second chart on the right. What I find, what struck me, and it's the first time I've seen this, is what's quite interesting is you show that 100% reserve margin, and you show prices, of course, elevated on a relative basis around 100% and gradually climbing. What we've seen in other markets that have employed an operating reserve demand curve is to achieve that type of outcome that you're seeing, which is you see as you gradually get closer, dropping from 150% of reserves, et cetera, on downwards, you have an upward sloping operating reserve demand curve that then hits penalty pricing when you get down to that minimum level of required reserves. And they actually do that to raise prices above the marginal cost of the marginal unit, or in the context of this discussion, above the DEV, let's say, if that's the proxy of the marginal unit, to try to achieve that. So I found it quite interesting that the shape that you're showing on that right part of the slide 11 is actually generally the shape that we're seeing entities trying to achieve through putting in or other organized markets through putting in an operating reserve demand curve. So even if bids are rated the DEV, the reserve price and then through co-optimization, the energy price gradually rises as you approach scarcity and get closer and closer to the minimum required operating reserves.
Thanks, Mark.
Thank you.
Okay, I had just a few more charts down this train of thought. The next one, yeah, really quickly. So this is just comparing your high-cost gas days to your high-price electric days, and you can see it generally. You're seeing the higher prices on the days where we have higher gas costs. I think everybody's aware of this. I don't want to call it a phenomena, but it occurs. And then the other chart that we have is our available RA capacity on a given day, falling short of our load forecast on many days. Now, this is just a snapshot, I think, of the most stressed time of the year, which is generally where we were also seeing those RSI failures. So there's a lot of lines on this graph, but I think the valuable part to compare is the day-ahead bids and schedules, which is what we care about from the day-ahead market standpoint, compared to what we thought the load forecast, our peak day-ahead load forecast. And you see just a general shortage in the amount of capacity that must be offered into the market on
Hey, Perry, this is Michelle Quito.
Sure.
This is a really interesting graphic, and I think it would help if you guys could unpack it. So some portion of that is going to be DR, right, because the CPUC relies on, 1,500 to 2,000 megawatts of DR. So if it's not called, then it shouldn't affect load. The other question is some portion of this is going to be renewable. So if your peak is at 5 or 6, the renewables are potentially going to be less, but, we've updated the ELCC in the past, and we continue to do that. Some portion of this is the CAISO allows resources to go on outage with or without substitution, so it would be interesting to see which portion of it, CAISO has control over. And then finally, I just wanted to make sure that for a long start, 3-day start use resources, that this because CAISO didn't start them up. So you would include those. So if you have a long start steamer, I would want to make sure that it's available, it's just not, maybe it takes longer. So those are the kinds of things that would be interesting to understand.
Yeah, at least on the point taken on the first few, but at least on that last one, I know that the operators have a process where every day they're looking at the result of the day ahead market, and they're looking out the 3 days to figure out if they need to commit the long starts. And what they're comparing is this peak day ahead load forecast of what they think that load forecast is going to be 3 days out. So in the process to look.
Right, but recall that the steamers have load factor. So, the bidding, but they really run like 1%. They don't really run. So I just want to make sure that this isn't capturing the steamers not being there because we don't start them up. That's all. Thanks.
Well, are you saying then that the blue lines would be lower without?
I guess all I'm saying is that it's important to understand. So on the next page, you're going to show outages. So, but what those outages are is really sort of important. So I'm just saying you've called it outages. The DR isn't necessarily on outage. Some portion of it you allow to go on outage on a day, well, with or without replacement. So I'm just trying to say that it would be important to look at all those aspects.
Yeah. So, go ahead, Amelia.
All right, one mic works. This is actually a chart from our annual report, and I'd suggest in the interest of time, if you have questions about it, please do review Chapter 10, which is where this is from. And we do spend some time unpacking the results and where those are from.
Right, and then the next chart was just to highlight that you have the total capacity required to meet the reliability obligation, and I'll just say, okay, well, we assume then we have the RA procured going into the day-ahead market, so we assume we would have at least that much bidding into the day-ahead market, and then what we see with the RA fleet that we're getting is whether, as Michelle points out, whether it's our own rules for taking outages or not, and use limitations and so on, you have a pretty large portion of the RA fleet out during these months. So you could be missing a rather large portion of supply on the days and the hours that you need it.
So are these what you might expect from eFord? Expected outage rates and so forth, or are these surprisingly high in any respect? Or
well, they were high. I thought this is an awful lot of megawatts.
Years.
It's not there that we would depend on for reliability purposes. But I'm not sure how much of this the E4D would catch over the course of the year. I don't know. We haven't calculated that. Yeah.
I just wondering whether our ELCC calculations based on E4D, et cetera, might be, overstating availability if 3 years of records seem to show that during the summer periods.
Yeah, that's kind of the gist here.
Where's Carl? Okay.
Carl took the day off.
But this is only counting the RA capacity that has to be designated for those months.
Yeah.
I mean, if it's RA capacity, it's presumably available the whole year, so the unit's still there, right? So this is just what was designated.
Sure. That's good clarification.
You have those shortages in the other months, but there's 4,000 or 5,000 megawatts of capacity that it actually exists, presumably.
Just hanging out.
I would just like for all of that to be designated, so I'm not missing this many megawatts of bids in the day-ahead market.
I saw that fly.
This is Chris from CAISO. I just wanted to add to John's point. This includes planned and forced outages, so it wouldn't necessarily be captured in any E4D calculation. When we look at the WEC-wide numbers for forced outage rates that are included in the NERC-GAD system, it was about 8% forced outage rate for all class averages combined. So I would say that this is above that 8% number, but that's including those planned outages. And then remember, we, kind of to some of the points that Michelle made and Perry made, we allow some some planned outages without replacement if we're going to look like we're going to be above the RA requirements. But sometimes we require replacement as well. So those aren't necessarily parsed out here in that unit outages figure, which is kind of important as well.
Do we have many planned outages in these months? I thought we usually didn't.
It's a good question, Brad.
Yeah, I think most of them be forced outages during these months, so that's a good observation. In the summer, we don't have a ton of planned outages.
Okay, so we had, I know we're running up against the clock here, but we wanted to get to the policy implications of this information for the CAISO, for load-serving entities, and for the CPUC. So I just kind of put these up here as talking points that, you know, we could have the MSC opine on. The three major categories of where this could go is load-serving entity energy procurement and hedging, which is completely in the hands of the load-serving entities and potentially the CPUC. You have resource adequacy provision changes that may help us move up that reserve margin portion of the one chart that I showed, and that involves various potential directions to go with these sub-items here. That could involve us and the CPUC, and then you have potential system-level market power mitigation process, which we would have the implementation considerations to work out. Not only, you know, setting up screens that, you know, where our brain goes here is you'd have to set up a screen in a way where you don't want to impact the scarcity pricing side of it, especially if supply is scarce. But you do want to capture if you're finding any supplier that may be able to exercise market power. So I don't think that it's a completely futile attempt for us to try to refine the RSI as we've proposed in here. I think if we were going down this road, how we calculate that gets into how we would calculate a screen for that. And then we were curious if there were any other related consequences that we're not thinking of on that point. Yeah, go ahead.
Can you go ahead and put the question through on the phone, please?
Hi, Perry. This is Callie Wells with WPTF. Actually, you just kind of touched on one item that I thought would benefit from being explicitly, I think, stated on this slide is really distinguishing between appropriate price formation under scarcity conditions versus, you know, pricing that might occur due to the exercise of market power, especially with the price formation analysis and efforts that are going on. I think it just kind of keeping that in our minds as we go through this is that under scarce conditions, you would expect and want prices to signal that. So I think that's a policy implication that would fit nicely on this slide and things to keep in mind as we go through this.
Thanks, Callie.
Well, this is Brad. I'll just you know, our thoughts so far on the system level market power mitigation process is, well, first, have we shown there's structural uncompetitiveness, you know, because there is the issue that we're just looking at what was bid in and, you know, related to imports. Is that the total import supply, or is there more supply out there that isn't bid in? So, you know, are these conclusions correct? And even if they are correct, then if we were to pursue some kind of automated system level market power mitigation process, how would that work? You know, we're struggling with, you know, determining DEBs for imports, and so how you would do that, and then also, what are the ramifications of that given, you know, for suppliers outside the ISO with their incentive to offer to us versus other markets if we were to start mitigating their bids? Maybe that'll key some discussion.
It looks like you guys just want us to discuss. Yeah, I'll repeat what I said earlier. Which the framework that was established, I don't know how long ago when we set up the LMPM process, the general logic was that there are certain types or subsets of the market that are going to be persistently, maybe just chronically uncompetitive We can't rely on new entry, on contracting to try to deal with that type of market power. It's a latent market power that's just not going to be something that would be corrected over, even the course of a year or two. And the general thought at the time was system-wide. You may have ebbs and flows of tightness of the market, but it's not something that would persist forever because of some structural barrier to entry or institutional, regulatory, environmental problems with entry. And that was sort of in trying to recognize that mitigation itself involves an assumption that we know more than we really do. We have to come up with DEBs. We have to come up with other assumptions about what we think the marginal cost of plants are, and there are costs when that is wrong. I think we just all along we've been trying to balance these costs of mitigation against the severity of the problem to try to apply mitigation in a measured way where we're confident that the benefits of that mitigation are going to make it worth it. And I think that becomes a much tougher problem at the system level, both because of some of the issues that have been brought up where, frankly, we've spent a lot of time over the last year really struggling with DEBs for even local resources in the EIM when it comes to alternative resources, energy-limited resources, and unidentified resources when we're talking about imports. So all those challenges would remain and would become probably, more pronounced if we start talking about imports. And again, that has to be sort of weighed against what we think the dynamics in the long run look like in this market. And I'll add one other thing. There's this interaction with resource adequacy that we need to recognize. We're applying mitigation to the price bids of units, and we're relying on RA must offer obligations to result in those mitigated bids actually being offered into the market. And it's still not perfect. There's outages. Your slide basically showed that, RA is not necessarily resulting in all that capacity shown up. And so if we are kind of forcing more activity, economic activity into mitigated bids, that's probably going to push at least part of the problem into the RA market as well. And we may be struggling more with how to mitigate market power in the RA side than we are actually on the energy market side. And the last concern that often comes up in these contexts is, to the extent the market is mitigating offers in a very comprehensive, to the extent it's mitigated a lot of the time, that starts to move some of the procurement decisions away from long-term contracts, away from hedging instruments that provide benefits not just to the competition, but we think are necessary for investment, necessary for a bunch of other types of activity on the generation side. And so we have to be cognizant of what the spillover effects of mitigation are in terms of what it does to procurement, what it does to other types of transactions outside of the ISO framework. That's not to say, I think one thing we really want to think about is, for example, ramping constraints, and if we are going to have maybe a chronic type of uncompetitive framework that's different than what we thought about in the past, in terms of we've thought about it all spatially instead of kind of technologically wise, and maybe one can make that argument. We're going to talk about that when we get to batteries and ESDR, whether, what types of other resources are available for that. I do think if we were trying to think about this as an analogous to the local market power situation, I think that we would require there be actual congestion on import constraints before something like this would bind. That's to make it kind of analogous. I'm not sure if it would have to be all import constraints or some, but that's just a brain dump of reactions that I'm just because you really wanted to stimulate discussion, I guess. So I'll just throw all that out there.
Yeah, I'll echo a lot of what Jim had to say. Structurally, if we had a competitive problem, we think of that as being defined by transmission constraints. So all ISOs have mitigation behind transmission constraints because the supply is limited, but they tend not to have mitigation for broad areas because they've got lots of imports. And the only exception really is ISO New England, because they're off in a corner and they're dependent on Hydro-Quebec, and the rest of them is behind Central East. So they are off in a corner and they have a single pivotal supplier test for the global market, but everybody else, if they figure they're not constrained, they can import it from their neighbors, and they're worried about congestion in local areas. And here, I mean, I think if I were thinking about global market power here, I'd say, are we getting in a situation where a couple of the major ties are constrained or they're down for maintenance and we can't in fact import, and therefore we don't have access to supply in the rest of the West? That would be, maybe we want to trigger it then, because then we're import constrained. But if we're got everybody that's able to offer and the prices are high and no one wants to offer more, it's not clear that's market power, as opposed to the prices are high, the West is short, no one else wants to sell day ahead because they're afraid that the gas is going to be worse tomorrow than it is today. And discussion there at the end that showing that, well, actually what was going on in these days was actually load was underbidding in the market, and then prices should reflect the expected price in real time, not just what their cost is today. So it's worth thinking about global market power mitigation, but I struggle with it when we're not import constrained. And again, to echo what Jim said, given all the problems we've had with hydropower mitigation, if we trigger global market power mitigation all the time, we'll be mitigating all the hydro resources in California. Right now, they're generally outside the constrained region, so we're not struggling with that. So
give me a thought. Do you think a useful metric would be comparing those RSI less than 1 hours with the unloaded capacity on the ties to see if we were actually import constrained?
Oh,
yeah, I mean, that would be very relevant. If Palo Verde were constrained and some of the imports from the Northwest were constrained, it'd be a lot more plausible that we had a market power problem on those days.
So this is Michelle Keto. I just want to say a couple of things. So first of all, we have this flex. I'm going to address a lot of these. So you guys say fixed price forward energy contracts. Well, I'd also like to say that the flexible capacity product is making it much harder to hedge. So if a gas-fired generation doesn't know how much it's going to run, then it doesn't hedge its gas, and then it doesn't sell its electricity at a fixed price. So we have sort of that's my issue with the flex product. Now, you can create some really fancy product to deal with this, but you basically want them to be, it's kind of like we've created a big PX again. So yeah, and then we're all going to be sort of in the real time. So that's one thing. The second thing, imports aren't showing up in the year ahead. So when we look from a reliability perspective, they want to be in the month ahead, day ahead, real time. They're not showing up in the year ahead and saying, maybe because they don't know what their hydro position is, they think it'll be better in the summer. So from a reliability perspective, that puts us in a bind. So we say, well, the imports might show up, but maybe we need to build resources, and then once we build the resources, then we don't need to be regional. But that's not really efficient either. So help me work through what the efficient solution is here if they're not showing up in the year ahead time frame.
But I mean, if you want to rely on imports for RA, then you want to sign, and if they don't, that's a message to you that you can't count on it. And you can say, well, I'll risk that maybe they'll show up, or yes, as you said, then you got to build your own. And all of the other ISOs have these models, and they say, okay, we simulate how much we can rely on the kindness of our friends given their supply balance, but we don't just assume it's going to be there. It's a very limited amount.
Yeah.
And they set their target given on, okay, we're going to get a little bit of help from our friends.
Yeah, and we pay them for RA and they bid at 1,000, and now you guys are going to raise the price to 2,000, and they're going to sit on our edges and bid 2,000.
I think that's a good question.
Yeah.
Should all RA, if we want to lock in a price, should DR have to be called at 500? Should batteries have to be held at 500? Should imports at 500 or gas at 500? I mean, if you want to lock in energy, I mean, you raise a good question. You know, aside from market power, we should be worried about in a tight situation LSCs that aren't hedged against energy prices just because the price is high.
Yeah, and some of them can't hedge because of that flexible capacity product that I'm telling you about, that most people that you would hedge with would be gas, but they're not going to lock in their gas if they don't know how much they're running until 2 hours before. I mean, we've created like quite an awful situation from my perspective.
Well, they don't have to, you know, they can lock in some gas at some price.
Can you explain why?
Like it's impossible.
Oh, sorry. Can you explain why you're saying the flexible ramping product?
Or I'm saying flexible capacity product, where you have to bid in. So
so you're referring to the RA requirement or to our market? Oh, okay, I'm sorry. Okay.
17-hour bidding obligation, but you don't know exactly how much. You can't sell all the capacity from your unit. The only thing you can do is a toll, and tolls are inefficient as well. So when you try to contract for a toll, you're going to have to price the number of startups. You're going to have to price. I mean, it's really hard to write a toll, an efficient toll. So I just add these things that, you know, in practice we're struggling with, and so we feel like we've bought these resources, we gave them to the CAISO, and what we have is the must offer, and it goes into the CAISO market, and then we get something that we don't really like because, you know, when the utilities owned 85% of it and we had excess capacity, we could be sure that people were doing variable cost bidding and that the market worked. And so now that we're losing this capacity on the edges and the utilities aren't owning it, and we can't be sure that they're doing variable cost bidding, it is a problem. But the problem starts to seem like not a competitive market. I mean, the solution starts to look like not a competitive market. So, I mean, okay.
Yeah, I followed you up until maybe I'm not sure what the definition of a competitive market in that. But so to follow up on what Scott was saying, you know, part of this is if to the extent we're worried about energy price exposure or bidding in at various prices, then there's just this policy choice about how much we want to layer into procurement mandates either via RA or some other mechanism. Where we've had these debates a long time ago about an RA mechanism that would have had either a strike price associated with it or a lower sort of requirement to offer in, lower than $1,000. And in general, LSCs resisted it at the time under the belief that it would make RA more expensive, and they didn't want to have, you know, all of those procurement costs sort of lumped under the RA product. They wanted more flexibility to procure energy, you know, however they wanted. And that's, I think, part of the issue here that we all need to work through is exactly how, whether we think there's something uncompetitive about either the supply side or the demand side that is preventing market transactions that we see in a lot of other ISOs that don't have any more mitigation than we do that seems to work.
Didn't Scott Harvey just say they don't rely on their neighbors? Right?
No, RA. When we look at when they simulate RA, they realize their neighbors may be short the same day they are. So they build enough capacity to meet their load with an assumption about, okay, that everybody in every direction is not going to have their worst day the same time. So we get a little help from our neighbors. But the RA models, and I'm most familiar with New York's in detail, but they model their neighbors and they simulate, okay, we can get a little bit of help from them on our worst day. We're not going to assume no help from our neighbors, but we're going to assume we'll get some, but then everything else we have an RA requirement for. Now, you got to decide. That's a choice you got to make. But
but then that
the more
sort of
you assume on your neighbors, the more likely you're short.
It kind of undercuts this whole effort all the regionalization effort. I'm fine going in that direction, but
it's not undercutting regionalization. Just saying that if they need their capacity to serve their load, BPA is going to shed their load to help out California, and PJM is going to shed their load to help New York, and they're not going to go short on their reserve requirements to help New York. So you want to have enough RA capacity so that, yes, if they have surplus, they'll sell it to you, but you don't want to be counting on them, A, calling demand response because they're not going to, and you don't want to count on them shedding their load because they're not going to. So you've got to have this balance of how much can you count on them selling you their surplus as opposed to recognizing they're not going to activate their demand response to help us out. They're not going to shed load to help us out. We've got to have enough capacity to do that on our own.
Yeah, in a sense, regionalization I can't believe I'm saying this, helps to do that sort of resource adequacy planning by avoiding the double counting. If you're sort of looking at the entire set of balancing areas as a whole, as opposed to sort of thinking that there'll be this kind of faceless import coming from somewhere in the northwest that's not being planned in a way that's reconciled and consistent with how we're planning for it. But also, there's regionalization is as much about short-term transactions than about sort of the long-term planning. And California is a little different in the sense that we historically have just relied on imports a lot, and so I don't know.
Okay, so I guess I just go back to
that. Defend regionalization a little bit and put it in context that having a big market means that we can suck in a lot more surplus than if we were dealing with individual balancing areas. When PJM and the polar vortex, they would have been shutting load if it wasn't a MISO. But because there was a great big MISO, they could get thousands of megawatts of imports because MISO was long, and there was a whole MISO coordinating use of the transmission system. So EIM is going to help us. It's going to mean that when there's slack in the rest of the West, we'll have a better chance of getting it. But we still have to recognize they're only going to give us their slack.
But I don't understand what's so terrible about system market power mitigation. It's not like we're saying you can't bid your costs and that you clear at the marginal price. I mean, why wouldn't we care? I mean, we've been through the energy crisis. We know what market power looks like. We've seen it before when there's lots of excess in the West. Shouldn't we be concerned about this?
I think the issue is if it's market power within California and you're trying to keep the generators in California from holding back or economically withholding supply, yes, then we need to address it. But if we're not import constrained and we're able to buy imports at a competitive price from the rest of the West, I don't understand how this is going to benefit as opposed to some scheme where we're hoping to clear the day-ahead market at an artificially low price and expect it to work out okay.
But why do you say artificially? But why do you say artificially low? I mean, I've just said that we'll let them do their marginal cost. I mean, I am actually saying we want a competitive market. We just want to enforce a competitive market. So I'm just not understanding why that's so awful.
If what's happening in some of these hours is the price is lower than it would be because the loads aren't bidding in all their supply in the day-ahead market, and the generators are therefore bidding in the expected price in real time. What we're going to have is if we say, okay, we're going to make all the generators in California sell at marginal cost, even when they know the price will be much higher tomorrow, where all the imports are going to pull out. Well, and then we'll have the satisfaction of buying from the California suppliers at low prices, but then we'll be looking for picking up a lot of supply from the West in real time, make, the operators do even more strange things.
So, I mean, more generally, conceptually, I agree with what you're saying, but we don't know what marginal costs are. We have estimates. Our estimates tend to be less accurate right when we would really rely on them more. And for a lot of generation sources, our estimates are pretty ad hoc.
Okay, so let's say right now it's 1,000. The bid cap's at 1,000. So if they want something more than 1,000, they can go elsewhere, right? So why are we raising the bid cap for imports to $2,000 without any cost justification? So they can go elsewhere now at 1,000. Why are we now saying you can sit at our borders and bid 2,000? Why would we do that?
Say we're not going to take any power over 1,000, they'll sell it elsewhere. I mean, it's
where else? Where else are they going to sell it at greater than $1,000? I mean, really, where?
Well, it's only going to happen on the days like when it got close, where there was gas curtailments in the Pacific Northwest and everybody was short.
I think we've had somebody waiting on the line for a while. Can we go ahead and take that? Operator?
Hi, thanks. It's Mark Holm with Power. So I just wanted to talk about one specific issue related to imports, and I think this is a really important element, and we've raised it in our written comments numerous times. I do not believe, from our experience, what is hindering imports contracting for RA is because external supply is unwilling. We see quite the opposite dynamic. There are entities out there, load-serving entities in California that are seeking to buy in the yearly time frame, and there is external suppliers seeking to sell on the year-ahead basis. There is a key barrier, which is the import capability that is allocated, that has really become a problematic allocation. It is allocated through a 13-step process, primarily on a load ratio share. Entities that get import capability, which you need to support import RA, may not need it, can hold on to that import capability through the year-ahead time frame, through the month-ahead time frame, and even just use it for day-ahead substitution or not use it at all. While there are load-serving entities looking to buy forward import RA year-ahead, there is external suppliers looking to sell forward year-ahead RA, but the import capability is inefficiently stranded with another LSE. And that process is inefficient, and it's harming both the external suppliers and the load-serving entities seeking to achieve their RA targets through least cost. And there needs to be a new framework for releasing that import capability in that year-ahead time frame. It's really just stranding import transmission capability from the RA in the year ahead and month ahead. The second issue that we're seeing is that for import RA, when you're heading into the peak winter and summer seasons, I think as was just discussed, there's numerous markets external, and the current system-wide RA program has a significant procurement 1 month at a time. A lot of the contracting that's happening outside of California is happening more on a seasonal basis, on a Q3 or summer season or winter season. So just as it's often, as Dr. Harvey said, too late to try to fill your capacity needs in the EIM or in the day-ahead market, it can also be too late to try to do it 1 month at a time if other buyers in the external region are contracting quarter ahead or summer ahead. And we see most other markets that have capacity markets or RA programs are more on the year ahead or season ahead basis. So I think the barriers as to why you're seeing limits on import RA procurement on a year ahead basis is really barriers that can be resolved to help support forward contracting for RA with imports. Thanks.
Thank you, Mark. We're well behind the agenda, and we are definitely going to be ending at 4. So I want to make sure that we have time for the last item on the agenda. I don't know if Perry and Amelia, you have any last thoughts? Amelia, we didn't get to your closing 2 slides, which were to stimulate discussion, but on proposals.
Closing thoughts. I think this is the beginning of a much longer discussion, so we should probably make time to continue it later.
Okay. Okay, well, thanks both of you. So at this point, we're going to go to the next item, which is ESDR 4, and John Gooden has a presentation. Pardon me? Oh, Gabe, okay. John will be just lobbing bon mots from the audience, I think.
Hey folks, NSC, thank you for letting me speak here. We are, as you mentioned, a little bit behind schedule. It's shocking to me that Jim said that we have challenges with calculating default energy bids. I'm here to talk about challenges with calculating default energy bids for energy storage resources, though. No, exactly. It's a shock. No, these things are very complicated. We are, in our ESDR 4 initiative, looking at default energy bids for storage resources. It's actually quite an interesting problem. Just to get started here, the ISO currently does not calculate default energy bids for storage resources, so there hasn't ever been a methodology in place at the ISO to calculate these bids. They're currently not mitigated through that local market mitigation process that we've been talking about earlier today. And currently there's not a ton of storage on the system. There's maybe a little bit more than 100 megawatts of capacity on the system. But there's a considerable amount of new storage capacity in the queue that's planned to be built over the next 4 years. Of course, we know not everything in the queue ends up being built, but even if a fraction of what's in the queue right now does get built, there will be a sizable amount of storage on the system. And when that happens, we certainly don't want the storage resources to be able to exercise market power We've talked about this in the ESSER 4 initiative, and I think we've gotten pretty robust stakeholder feedback on that, that folks want to make sure that there is something in place. But the big question in the room is, what exactly do for this? So I'll also note that storage is often suggested as a solution for local issues to mitigate retirements for essential resources. So you might have one local area, part of the solution to mitigate for a retirement of a specific resource in that local area, maybe to improve transmission projects, but just as likely it might be to build some new battery resources in that area. And often the plan for those battery resources is to sort of transfer energy that's generated during our peak solar hours to times of the day when we have our peak net load hours, and it's sort of often how batteries are thought of and how they're used in our system. However, and this was something that the folks in DMM pointed out in their annual report, this is not exactly what we're seeing from behavior from storage resources. So I did shamelessly pull this straight from Department of Market Monitoring's 2018 annual report, and this is figure 1.11 if anybody wants to reference it. I will say that in policy we're developing some of our own metrics, and we're able to replicate this particular chart. Probably what we'll do and what we've started to sort of drill into are some specific days from last year when we saw extremely high prices and sort of what the pattern is for energy coming in from storage resources during those times. And perhaps not surprisingly, a lot of those patterns look pretty similar to what we're seeing up here, or sometimes even lower in terms of the energy that we're actually seeing when we do have those very high price days. So as I said, there's about a little bit more than 100 megawatts of storage capacity on the system today. And what this graph shows is that frequently, even during those highest priced hours for our net peak loads, hours 19, 20, 21, we're still only seeing about, on average 20 megawatts of storage resources coming in. Of course, these are averages and things change from day to day, but even drilling in on this data, we're still seeing fairly low levels of energy market participation from these resources.
But I mean, if they're providing reg up and that frees up other resources in the energy market, I don't see, I mean, if we've only got 100 megawatts and we're getting 60 or 70 on average, that seems like a pretty high rate to me, not a low rate.
So just thinking about the energy at the fairly low rate, if you add in reg, I think you're right. We're getting higher quantities there. So I think that's a fair point.
And it's presumably it's freeing up other resources too that otherwise would be providing reg.
Yeah, I think that's a fair point. And then I think to dive into that idea just a little bit more. Oh, yeah, go ahead, John.
I think, Scott, goes to that earlier bullet about displacing some of these resources that are the ones that you're moving for regulation or freeing up capacity, or the thermal fleet, for example, but this is going to displace those. So what's going to take all that renewable energy out of the belly of the duck and move it to that net load peak period? Just freeing up resources for regulation, maybe that's great short term, but are these resources going to be able to actually move those big chunks or tranches of energy between the belly and the head of the duck?
And kind of the follow-up that I was going to add there is, a lot of the storage resources that we've talked to say that they specifically want to manage their resource in such a way that they're regulating for most of the day and they're not providing energy. And we'll get into some of the costs for that on the next slide. But that's sort of their operating paradigm. And I think that gets to John's point, is when they are just providing regulation, they're not really moving that energy from the 4 hours when we have a lot of solar, 4 hour net loads.
So, Gabe, the use of the word paradigm, is that same as profit maximization because of regulation prices being what they are, or is there some life preservation for the batteries? It's just
I think it has a lot. It has very little to do with the numbers that I've seen with the prices of regulation, but it has a lot to do with saving the batteries from cycling. So what we've heard from storage resources, and we've gotten some written comments on this as well, are that it is, in fact, very expensive to cycle these resources because you get cell degradation on individual components of the battery, which leads to having to replace those components sooner than you might have otherwise done. And I think primarily what these resources are doing is sort of bidding into the RA capacity market, and they're getting capacity payments, and that's sort of where they're making their money. And then as long as they're providing bids into the market, and they're bidding in such a way where they're often being picked up for regulation rather than energy, and if they're not being dispatched for energy overly frequently, then they won't have any issues with that cell degradation. They can sort of maintain that capacity through the life, maybe a 10-year contract or something like storage resource.
And they are available for energy on those days when the system is stressed, which is ultimately the central core purpose of RA. So,
well, they have a must-offer obligation into the market if they're clearing for RA, so they're required to bid. But like we say, they can bid in such a way where they're often picked up for regulation. And what we're seeing on those very high price days is often we're not getting a whole lot of energy from the storage fleet. And
only have to bid. So suppose that the regulation price falls to 10 cents, yes, and they bid 15 cents, and they never clear. Do they still get their RA money?
Yeah, as long as they're bidding in the market. Yeah.
Mm-hmm.
Okay. So when we're thinking about default energy bids, we're primarily trying to capture the marginal cost for a resource to operate on the system or its variable costs. And we've been able to break these down into 3 different categories. Those 3 categories include energy costs. So when a resource is going to discharge, and you can think about it as discharging perhaps during the peak net load hours, they're going to have to charge the battery from someplace because they don't actually generate any energy. So they're going to have to actually purchase energy at a different time during the market. I think we have a relatively good basis for being able to calculate typically what these storage resources might be paying to purchase the energy, because it's typically going to be during the cheapest energy priced hours of the day. And the second component is losses. So there's 2 different types of losses that we've identified for many of these resources. There's round-trip efficiency losses. So let's say I'm a storage resource and I charge my storage resource up to 10 megawatt hours. Well, even though I've paid for 10 megawatt hours of energy, I may only be able to discharge 9 megawatt hours because there might be some losses between when I charge my storage resource and when I discharge my storage resource. Additionally, there could be parasitic losses. I will just note that a lot of the new storage resources that we see in the development queue are lithium-ion for their technology. The lithium-ion batteries typically don't have very high parasitic losses, but there are other kinds of batteries, even some that are on the system now, that do have higher parasitic losses. So I think it's worth mentioning that it's out there. But that's generally when a battery is at some level of storage, they'll slowly see that level of energy that they've got stored decline over time, just as the battery's sitting there. So those are our losses. The third category that we've outlined are cycling costs, and this is sort of what I was describing to Ben a minute ago. But cycling costs include batteries are made up of mini cells, or these lithium-ion batteries are, and every time those battery resources cycle or run from being charged to discharge, or perhaps running at the same number of megawatt hours that the battery is rated up to, that's considered a cycle, those batteries start to degrade. What we've heard is some of these, and again, this is from talking to some of the folks in the storage community, but some of these cells degrade faster with deeper cycles. So if you take a resource all the way from its Pmax all the way down to its Pmin, all the way from its maximum amount of storage capability down to its minimum or 0 amount of storage, those deeper cycles cost the storage resource more in terms of degradation of the cells than if the battery was charged a little bit and discharged a little bit and charged a little bit and discharged a little bit, but at the same number of megawatt hours. So one of the questions that we'd like the MSC to sort of opine on is whether or not these costs should be included in the default energy bid. We've got a lot of feedback from the storage community that says, yes, indeed, these costs should be included in the bids. But as I mentioned, these resources are also receiving capacity payments, which may offset some of these costs to build the resource in the first place. But On the flip side of that, there's also variable operations and maintenance and major maintenance adders that are currently in place for gas resources today on our system that are sort of akin to some of these costs. But I think we're in a little bit of a different situation here with these resources. So again, something for the MSC to think about. And then, as I think we've noted, what we're seeing in the data from these markets actually participating in the energy market, and kind of the anecdotal evidence that we've heard from some of these resources are that, in fact, if these resources are cycled multiple times per day, it may actually degrade the batteries fairly quickly. And if that happens, it might mean that it's fairly expensive to replace these storage resources. If that's the case, we might be looking at actual dispatch cost, actual marginal cost to run the resource of maybe upwards of $100, $200 per megawatt hour if they're being discharged several times a day. Yeah, question, Adam.
Yep. Hi, this is Adam Swadley from DMM. I guess, and just a couple of things here. So on the subject of cycling cost, I appreciate that you're thinking about that and how you might want to include that, because it does seem like a very important thing, and whether or not it belongs in a DUB might, be a continued discussion. But it seems appropriate to do that to the extent that it is a function of incremental megawatts produced. If it's a function of something else, then maybe you explore some other way to capture it. But having those costs included and modeled somewhere does seem appropriate. The other thing, though, that may be worth giving some thought to is that on this list of costs, I think I agree with everything that's listed up there, but something that's noticeably missing is opportunity cost, specifically opportunity cost that just comes from the nature of a battery for what it is. So it's sort of inherently limited in the sense that, with a given state of charge, it can only run for so long before it needs to, again, charge and replace that energy. And in doing so, it may be missing out on other opportunities to discharge at a time that may have been more profit maximizing. So just thinking about ways how you might model and incorporate in a DB the sort of trade-offs that a battery might need to make over the course of the day to capture not only the cost of the energy used to charge and its maintenance cost, but also opportunity cost if it were to discharge at a time that ultimately isn't profit maximizing over the day.
Yeah, thanks, Adam. I actually have that here as a note to add as a sidebar. Just for full disclosure, this is sort of what we outlined in our last version of our straw proposal. But we're certainly, I think, in your comments that you filed in response to that paper, you were very clear about opportunity costs. I think we agree wholeheartedly that those need to be included and at least considered when we're calculating our default energy bid. So we do want to at least make mention of that in our next version of our paper. I was certainly going to call that out here, but I appreciate the comment, and we're definitely moving in that direction to capture some of those going forward.
One other cost that came up in reading some of the stakeholder comments was it appears that the ITC, the tax benefits, are dependent on them being able to argue that they were charging with solar power as opposed with other power, and therefore that the cost may be very different charging at night than during the day, and that may be, driving some of this behavior, especially for, it seems like that wouldn't be a problem for the evening ramp, but it might be a significant issue in how they bid to charge overnight for the morning ramp, and that would be, of course, we probably don't need them as badly for the morning ramp as the evening ramp, but that might be a difficult issue.
Yeah.
So you're saying qualifying for the ITC would depend on...
75% of the energy has to be from this chart.
Okay, then they get the 30% ITC that solar does, which is absolutely huge.
Right.
So that's a constraint that they might hit.
Apparently, a number of them said that was an issue if they charged a lot at night as opposed to,
yeah, we've received that same feedback on my end as well. So I think that's definitely something we'd want to consider.
But yeah, if we can keep them to use them a lot on the evening peak and a little only a higher price, might say set a higher deb for the morning peak, so we only use them when we really need it, and use them more often on the evening peak to keep their. I mean, we have DEBs and for other things to reflect the tax subsidies, you know, the wind and everything else. So it's no different than
as a function of when you charge. That is
I know.
That is a wrinkle.
That's the government's fault. The other thing that it struck me is I think it's important to do a deeper cycle issue and understand, is it per megawatt hour or is it deeper cycle? Because you talked about a maintaining state of charge parameter, but I was thinking if the issue is they don't want to go below 25% unless it's really worth it, we could have a dispatch price that says it's such and such until you get down to 25%, then it goes up $150, and then when I get below 10%, it goes up $200, so that we'd only be using them, only do the deep draw when we really, really needed it, and they could bid, you know, more moderately for, you know, getting run from 95% down to 25%, say. If they knew that then we wouldn't take them below 25% unless we were going to pelt them with $100 bills.
Or perhaps that's an adder or something that kicks in automatically.
We'll have a bidding structure that instead of the bidding be dependent on the megawatt rate at which you depend on, once they go below that state of charge, we have a higher.
Now, one thing I will note is that generally in the day-ahead market, we're doing calculations for default energy bids, and those are fixed for the day. So a lot of the things that we're kind of thinking about with these storage resources are DEBs that may fluctuate during the day. So I could see this potentially sort of getting into maybe some thorny technology type issues as we dive a little bit deeper.
But if it's just a technology issue as opposed to you can't make it work, that's better, because we just have George work a little harder.
Well, I think he could get it. I think he could crack it.
Clarification.
In fact, there are, ISO New England did an offline testing of what it would be like to dispatch batteries considering these drawdown costs. It turned out to be a bit more complicated than just you don't want to go below 25%. It's how much you go during the day. So if you start low, you can go lower. But I gather it's a convex formulation. It could be linearized, so it's possible to include, but then if the parameters are very technology battery dependent or brand of battery dependent and so forth, and that may not be a place where you want to go.
Yeah, we've also got...
Figure out what battery they got, and they can figure out. We just need to give them the flexibility.
Right.
That's right. They can bid it, but if we're trying to figure out DEBs, and if the DEBs depend on where you start the state of charge at the beginning of the day and things like that, it could be a little bit messier. But there is information on that. I can nose around before next time we meet.
Oh, yeah, if you could send that my way, I'd appreciate that. Chris, did you have a comment?
Yeah, so back on the ITC issue that Scott raised, I just wanted to clarify. I believe that that's specifically related to hybrid resources that are combined. So I haven't reviewed these comments specifically on this stakeholder initiative yet, but that I just wanted to clarify that. So I think that there is going to be a majority or a large chunk of these battery resources that will be under hybrids in the future. So we do need to think about that. But that whole idea is just when they're like combined into one or two resource IDs that are, you know, co-located.
I think we also had a question on the phone line too. Let's go ahead and take that, operator.
Hi, Gabe. This is Mike Castellano from CPUC Energy Division. If you could go back one slide. Okay, so one thing that kind of struck me as I was looking at this is you have basically designed a DEB for resources that are going to charge in the middle of the day and then discharge at night, right? That's kind of how you're approaching it?
I mean, I think to start this initiative, when we were initially on our issue paper and our early thinking, we were looking at sort of at a very general level, we know that 4-hour batteries are sort of the modal battery that's being built on our system today. So just thinking about prices and where you'd be able to maximize, there's sort of two different times of the year. There's sort of the spring time of the year when we have these peaks in the morning where we see low prices overnight, and then we see high prices during the morning peak, and then we see low prices again sort of when solar comes online, and then we see high prices in the evening, and then sort of other times of the year, mainly prices are more or less flat during most of the day, and then they sort of increase in the evening hours. So we were sort of thinking about a 4-hour battery and when they could potentially make money, and if you start thinking about losses and you start thinking, well, you're going to need some money to cycle, and you want to be capturing some sort of a spread between when you're buying energy and selling energy, you're probably able to do that maybe once a day during the peak solar hours to the evening peak net load hours when you know, sort of capture that spread between low prices with solar and high prices in the evening, or potentially during some of those spring months when you do have that price separation in the morning as well. So probably, you know, thinking about a 4-hour battery, 1 to 2 cycles per day.
Okay, but so you're thinking about 1 to 2 cycles per day is what resources might want to do when they have a mitigated bid. And obviously this is an evolving market, but what you're showing here is that most of the resources are sitting on reg, which is not 1 to 2 cycles per day. It's small adjustments up and down constantly all day. I don't know what the actual mileage usage looks for these guys, but it kind of seems like you're approaching the DEB to design for something that is counter to the revealed preference that we're seeing here.
Yeah, Mike, this is John Gooden. I agree that, and I think that's why we're, you know, looking into this information, because it is different than I think what the intent with storage as an enabler of renewable integration, and the idea that it's going to move large chunks of energy out of the belly of the duck and create that load shift and shape that we need. And so, you know, that's sort of, I think, what people are thinking storage is going to do, and why I think it's a little bit surprising kind of what, even though it's a small amount that we have this time, but how it's actually operating in the market is different than that. And so I think we need to think about what is the right approach with storage, particularly electrochemical and the DEB.
And you know, that's kind of the sort of bigger question, I think. But just in terms of DEB design, you know, sort of designing the DEB for the model that you want in the future, and ignoring what you do have going on right now. Not ignoring, but, you know, not as proactively dealing with what you do have going on right now might not be the most advantageous way to go.
Yes, I think your point is well taken, Mike, and that's something we're thinking very seriously about, and we're working with the storage resource owners right now on how these things should be characterized, but point taken.
All right, thanks, Gabe. And John?
Yep, thank you. Adam.
Yeah, this is Adam Swarthley from DMM. So I'll just say one thing that I think, you know, what we're seeing in terms of the provision of reg and this concept of cycling by, you know, charging for several hours in the belly of the duck and then discharging, you know, in the peak hours, those two ideas in terms of effect on the battery and maintenance cost may not be entirely inconsistent with each other, in the sense that, you know, a cycle, at least as I understand it, and Gabe, please correct me if you've heard something different, but a cycle is a function of, it's a single total discharge of the megawatt hour capacity of the battery over any amount of time, right? So it can be lots of small movements up and down over the day, i.e. regulation, or it could be one continuous discharge for a block of energy. Either of those things could total up to one cycle. Is that consistent with your
That's consistent with what I've heard as well.
Okay, so given that, if you have a battery that, has a maintenance agreement that it, wants to cycle roughly once per day, it appears based on what outcomes we're seeing that it can maximize its market revenue and stay within the bounds of whatever contractual agreement by providing regulation instead of providing this sort of load shift that we're thinking of. And so maybe part of the issue there is that that is the preferred way to go about it. Again, getting back to this issue of trying to reflect maintenance costs in the market and have them optimized so that a more efficient decision about how to use the resource can be made. But I guess the main point I wanted to make, though, is that I don't think that seeing the resources providing regulation like this and the idea of a once-per-day cycle between, midday and end of the day, from a maintenance perspective and an operations perspective on the battery, those things aren't inconsistent with each other. It's just an issue of how the resource maybe can maximize its market revenues. So.
Yeah, I think we agree with that, and I certainly agree with the statement that we are seeing these resources provide regulation, and I think a lot of the reason why we're seeing them provide regulation is because they don't want to cycle and sort of degrade their batteries and incur some costly replacement prices there. That said, this might be the strict preference for the storage resource, but I wonder if there's, perhaps something that's implied by some of the data we have with some of the very large price spikes in the summer months, where we're not seeing energy from storage resources, where perhaps that may actually be something that's more profitable for them. So we're still certainly thinking about this and looking into the data, and we want to come out with the right.
I think it's important to, what Adam said is that it's just the megawatts they move, and it doesn't matter whether they're going down a lot or not. That's important. I think we need to understand whether it's the deep drawdown or just how many megawatt hours they discharge over the day period that drives the cost, because with just that many megawatt hours, then there's not much we can do. They can't provide a lot of help, but if there's something where we can do to minimize maximize their value to us and minimize the cost impact, then we can try to accommodate them.
Well, I think, like I said, the definition that we're working with is that a cycle, yes, is a complete drawdown of the number of megawatt hours that you can store in your resource from full to zero. But it's the aggregate number of megawatt hours.
And Gabe, this is John.
Yeah.
I don't believe that's necessarily the case. From literature I've read, that it's the number of cycles is a difficult definition. It's like, what is a cycle when you write a contract? So maybe it is just the megawatt hours of that battery from fully charged to discharge, and it can take a while to get there if you're on reg versus huge charge, discharge cycle. One, completely deplete the battery, completely charge it, completely deplete it. But that's more taxing than just these little movements on the battery. But we do have to have a definition for a cycle. But I don't equate those two as fatigue on the battery, number of cycles. It depends on how you cycle it.
Well, and that was exactly the point that I was getting to. I think the definition for cycle may be somewhat clear, but the actual costs for those cycles, those small changes versus the large changes, I think that's where we've got some difference, and that's what's going to come into play when we start thinking about the default energy bid. Okay. Any more phone calls on the line, Shami? Thank you. So we'll move on here. Variable costs for storage resources may be significantly higher than gas resources. I've already alluded to this. But storage resources currently online may have warranty agreements with manufacturers, and I think to some extent that's sort of driving some of the behavior that we've seen, and we've already talked a little bit about this. But for example, cells may be guaranteed at perhaps maybe 90% of their nameplate capacity if the resource is only cycled once per day, perhaps over a 10-year period or something like that. And that's sort of some of the numbers, give or take what we've heard from some of the market participants. And exactly to that point, if you only want to cycle once per day so that you're within your warranty bounds, perhaps the optimal strategy for you is to really just bid into the regulation market where you're dispatched up a little bit, you're dispatched down a little bit, but by and large you're not making these large movements from the energy market where you're dispatched all the way down to a completely depleted battery to a completely stored battery or something like that. So feedback from stakeholders suggests that bids that we currently see may be reflective of those contractual penalties rather than their true cost to operate the resource. I think one approach that we're thinking about taking with the default energy bid is to sort of come up with what those true costs are to operate the resource.
It sounds to me that they are bidding the true cost, that they really have these degradation costs, and that it's reflected in the contract. But yeah, they'll wear out the battery, but that seems to me to be a completely true cost.
Yeah, this is similar. I know we've had this principle that we don't want to, we want actual costs, not contractual costs. But we went through this in the major maintenance initiative, where the major maintenance is a contract, and so it gets to a certain point. Well, is that a contractual cost, or what you pay the maintenance guy through the contract? That's really the true maintenance cost.
And do we want to second guess what the manufacturer says the cost of wear down is? Do we really know better?
That's what they're basing this contractual penalty on.
Well, it's a little bit interesting, Scott, because if your one goal is to only cycle the resource once a day or less than once per day, I mean, you could certainly bid in such a way where you could estimate what you think the lowest cost hour of the day would be and what you thought the highest cost hour of the day would be, and you could bid in such a way that you'd be dispatched during those two intervals only, and you might just ignore sort of this regulation sort of noise on the side of that, and it doesn't seem like we're really seeing that behavior either, although that might also be an optimal strategy or may yield more revenues. I'm not sure. But we're not.
We need to understand the cost, because it's not clear to me if it's just a pure megawatt hour movement cost. I'm not sure regulation doesn't end up moving you more.
Right.
So that's why I wonder if it's deep drawdown costs what you had, and we've got to understand what these costs are.
And I'm wondering those same things. I've got exactly those same questions. And then the other thing is, if you look at 5-minute prices, you don't typically, I mean, occasionally in the evening you'll have like a concentration of very high 5-minute prices, but often if you just look at the highest 5-minute prices, they're scattered throughout the day. And you would think that a resource, bidding in at some high level would want to capture exactly those price spikes and do nothing else, and we don't really see that behavior in the market either. So it's puzzling to me.
Again, that might be because they're afraid if they put in a $100 price, they'll not only capture those, but they'll get stuck and they'll run them down to zero. And that's why I was thinking if we understand what it is they're trying to avoid, maybe we can structure the bids and the dispatch so that they can give us what we want and we won't do what they don't want us to do to them.
I think that's totally fair, and we have looked at a lot of historical data, and typically even setting a bid as high as $70 or $80 would sort of avoid most of that.
I just want to tie this into the discussion we just had about system-wide market power and why don't we just mitigate everybody.
Yeah.
I don't have a high degree of confidence that we know what the right mitigation price is here for sure.
Yeah.
And it's a great example of the cautionary tale.
I was musing over that as the discussion was unfolding as well.
We are worrying about how we can use the resource because we have to set the DEBs.
Yeah. Yeah. So with the current bidding strategy, we do see that these resources would be rather expensive if what they're bidding in today really is reflective of what those costs are, which I think is a somewhat questionable assumption. So in the, I know we just have 10 more minutes here, so we'll just run through this and take questions as they come up, but I'm on the second to last slide here. But in the initiative, in the proposal that we recently put out, we put out 3 potential solutions. The first solution, and this is sort of what we actually launched as our proposal, was that we would create a DEB for storage resources that sort of limits the amount that resource would run. So, for example, you know, if we thought, and again, this would have to be something that was run by stakeholders, but if we thought that, you know, 1 cycle a day was appropriate for most lithium-ion storage resources, well, we could come up with some sort of a DEB that would say, you know, on average, maybe cycle the resource a half a time per day, or maybe 3/4 of a time per day, and then set the default energy bid based on that number, which really, I think, to perhaps Jim's point, doesn't have a whole lot to do with what their true marginal costs are, but it would be a way to sort of put an upper bound, perhaps, on the frequency in which they ran, and still would give us something to mitigate these resources down to, which might, in fact, be lower than their true variable costs. And then in order to do that, we'd, of course, have to forecast what we thought prices would be, which I think isn't a small task, but MQRI currently does something similar to this for forecasting for the opportunity cost adders for the default energy bids, so we could probably piggyback off of some of that technology. We also considered making a blanket default energy bid that would be a little bit more general for all storage resources. So currently, the variable cost default energy bid for all resources in the ISO includes variable operations and maintenance, and those variable operations and maintenance numbers are specific to a particular resource type. So combined cycle resources have one variable operations and maintenance cost. Hydro resources have a different. Solar resources have a different value. Resources also have major maintenance adders, and those are resource specific, and I think, like we heard Amelia say, those are specific to commitment costs, so your min load and your startup costs, but not necessarily to your variable energy. So perhaps with a hybrid adder somewhere in between the variable operations and maintenance, that could sort of, or that does sort of blanket all of the storage resources and something that it could be tailored to a specific resource. Maybe just a simple adder would be enough, tailored to individual storage resources for a DEB. That was one of the things we considered. And then sort of the third option that we considered was a default energy bid that included those 3 costs plus opportunity cost adders, something to incorporate opportunity costs that I discussed a few slides before. And this would sort of be a methodology that would be akin to the methodology we use for gas resources, where the ISO sort of did try to do this calculation where we said, okay, if you have these costs for losses, if we have this expected cost that you're going to be buying energy at, and you had these other costs for, you know, opportunity costs for selling energy at a particular time, how would that DEB actually shape up? And that would be something that would be customizable for each resource. Of course, it would entail the ISO collecting a lot of that information up front for every energy storage resource that came on the system. So that was also something that we're thinking about. I think that sort of gets to the meat of, you know, where we, of course, I think to the point that we've already made, we want to understand sort of how these costs work a little bit more and what we're actually seeing in practice for actual resources that are being built and are currently online on the system. But then ultimately, sort of what direction do we want to head down between these 3 choices?
This is completely contradictory to what we were talking about earlier, but you know, another direction to go here would be to say, how about putting a minimum that if a resource is below some level, we're not going to subject them to mitigation? I mean, if the owner, all the batteries he owns in the constrained area is less than 1 megawatt or 2 megawatts or something, we're not going to mitigate them. And avoid the need to, because if we're going to have to devise a resource-specific number for every 1 megawatt battery or 1.5 megawatt battery, is that the cost of doing it exceeds the benefit? Right. And maybe changing the, you know, so that, and we wouldn't mitigate all the resources if NRG failed. We wouldn't mitigate all the 1 megawatt batteries within the region. And so.
We
don't have that now for the present LMPM system. There's no de minimis.
Yep.
Yeah, but can't even that 1 megawatt then set the price in the local area?
Does the 1 megawatt guy have an incentive to, we're talking about market power. If it's a 1 megawatt battery, they're economically withhold their 1 megawatt in order to drive the price up for somebody else.
Yeah, if there's a 1,000 megawatt pivotal supplier, if they withhold the 1,000 megawatts, they can set the price, but that doesn't mean right. But if a 1 megawatt guy, you can't set the price if there's some other guy who's 1,000 megawatts who's pivotal.
And I think we chatted a little bit about that prior to this conversation, and I think that's a good idea that we'll at least ponder through this process. Anything on the phone, Shami? Okay, thank you. I do have one more slide, and this sort of outlines sort of the methodology that we talked about in our paper. And again, this is sort of a methodology that would sort of calculate a bound around, let's say, 50% of the maximum amount of discharge for a resource. So if the resource had 4 hours of discharge, that would sort of calculate what the expected prices in the real-time market would be for the the peak 2 hours of prices, and that would be used as the default energy bid and perhaps a 10% adder or something. And this is sort of the direction that we're thinking about currently. But I would say we're not wholeheartedly committed to this, and we're still kind of contemplating at least some of the other ideas that we've laid out as well.
Again, the structure of these costs matters a lot because, if it's 1 cycle per day, or is it 365 cycles a year? If it's 365 cycles a year, then it's a more longer-term cost than if it's once a day. And so really we have to understand the details of these costs before we can.
So, we have had a few conversations with these operators, and from what I've heard from them is, more or less you can linearize it, but it certainly is the case that if you do these deep cycles, it's more expensive in terms of degradation. But kind of the amounts I don't have anything on that.
Not to pile on all this, but I think one other thing to consider is for all of these storage-like resources is one of the advantages of markets is you get to collect the information that they are revealing to you. And since so much of storage resources is about making forecasts about future prices, you're kind of eliminating the ability of the market to reveal what they think the future will look like if you're kind of dictating exactly what these opportunity costs are through some formulaic measure. Yeah. And that's just a specific sort of thing to, in a sense you could argue with some other types of resources too, but it's really pronounced in the storage resources.
Mm-hmm. Yeah, I think that's a good thought. I appreciate that. Any other questions or comments? Dan, maybe I'll turn it over to you.
So offline, I want to poke around at some of the literature on cost of cycling and so forth and see whether those types of numbers are significant and are worth putting in, considering then an option number 2 from the previous page. But I don't have those cost functions memorized. We did have another part of the presentation that Perry is going to present about a technical feature to include in the market software, considering the ability of storage generators.
Saying no.
And we were going to have that, but I think we're out of time, so we were going to pass on that. But it was just to summarize what that was. Among the technical parameters that a storage device could put in is to say that at the end of the day or at some particular period of time, I want to be at a particular end of hours place. Just like with a water reservoir, that at the end of the month I want to be full or be half full or whatever, and that would give the bidder a little bit more flexibility in terms of how they manage their resource. But we're going to skip that in the interest of time. We've had a lot of important discussion between Dame and, did I mispronounce that? It is Dame, or is it? Yeah. Okay, somebody else was using another pronunciation earlier today.
The market.
I like the Dame market.
Yes. Okay. Yes. As well as system market power. So we're tentatively meeting again Monday, August, is that the 19th? And it is confirmed, so it'll be a Monday rather than a Friday. And we've already got 7 items on the agenda. We will trim those down. At this point, we'll see if there's anything else that anybody wants to raise at this time, any further business.
Not from Scott.
Okay, not from Jim. Okay, then I will wish you all a good weekend, good remainder of the summer, and see you in August.
Yeah.
So, operator, we are finished, and you can now disconnect us.
Thank you, Christian.
Thank you. You all have a good night.